Hello and good afternoon, or should I say good evening, everyone. This is Tim Davis here coming to you guys with another market review as we begin a new trading week. And today is Tuesday, June 21st, 2022. The time is now about 3:24 p.m. Eastern Standard Time. And I wanted to try to get in a quick market review for you guys here. All right, we'll start off by taking a look at all the major indices and show you guys what is showing up in the near term. And then I'm going to take a look at the long-term monthly charts to show you guys that we are not out of the woods by a long shot. We have a long way to go in this bear market. Okay, so we are in the process of experiencing another bear market rally. And here, I have drawn some Fibonacci retracements on some of my some of my index charts that I've been watching for the past year or so. So with this Russell chart here, it's the Russell 2000 that we're looking at. What I pretty much did was, because I pretty much think that we are going to follow a pattern down as we follow the pattern up from the 2009 lows. We follow the pattern up, and I think we're going to follow a pattern down. So the lows we got to in 2009, I drew a fib line from that level to the high point of 2022. Yeah, 2022, beginning of 2022, or the end of 2021, should I say. Hence, then I was able to take a look at the possible reversal points according to Fibonacci retracement from the levels we've seen from 2009 up to now. All right, and now if I go back to a short-term daily chart, you'll see we are at pretty much a level that we could see a possible bounce. Well, we reached that level, which was back on the 17th of this month, where price action showing us that we should see some type of bounce, and we are experiencing that bounce now. Now, because I think we are in a steep bear market, I don't think this rally is going to be sustainable. Not a long sustainable bounce. So let's point out some possible levels that we could see a possible reversal back to the downside. And I do think any reversal back to the downside is going to lead to lower lows. All right. So if we look back around May the 12th, there was a point here, right here, where price action started to go higher, then a little bit more, and then went higher until it got to a high point, then it started to reverse. So this point right here is a good area to determine a new short-term area of resistance. New near-term area of resistance if for some reason we don't rally back up to the 20-period moving average, which I don't think we might not have enough steam in the market to do so. Anytime, if you notice, anytime we have these big market rallies now, right after that market rally, we have an immediate reversal. So I'm under an inclination to believe that we are going to have immediate reversal of this rally that we've seen today. So with that said, I just drew a trend line of where price action could go, and as you can see, we are right back up to that level now. So we could be ready to start to see a reversal back to the downside, which could in turn create low lows. So we could break this low before the end of the day tomorrow, or by the end of this week. Now, if we break through this and continue higher on tomorrow, then the next level that we can see some resistance, it will be probably right around this 20-period moving average. But one of the reasons why I don't think we're going to go much higher is because I'm really paying close attention to the VIX. Now I'm going to switch right to the VIX before I look at the other indexes. Right to the VIX. And I pointed out this point that the VIX, I told you guys, the VIX is in a process that it wants to break above this upper trend line you see me got drawn here, which is that $40 level, or close to the $40, $39 level. And the VIX gapped up on last week. And 9 times out of 10, because VIX is an oscillating index, when it gaps up, it normally it's going to come back down and fill that gap. And it did that perfectly over the past several days. So here's our gap right here. And then look at the gap fill, folks. Look at the area where the VIX just came back down and filled this gap. So here, is our gap fill area. So this triangle pattern here is what I call the gap fill area. So price action went up, came back down. Price action gapped up, came back down, filled this gap. This is the gap right. This is the gap right. So this is known as the gap right where the price action gapped up. So we fill this entire gap. So I'm just drawing this is just a highlight so those folks who don't understand technical analysis can really see. This gap right has been filled. And since the VIX is in an overall uptrend, what happens after the gap right is filled? Then VIX is going to try to find support for the bounce. And that's why I believe we probably won't see these markets go much higher than what they are now. Great rally today, but I think that rally is about to be reversed. It was a strong rally, and because of that strong rally, I think we're about to be a reverse, and also another indication that we could be about to see a reversal with that strong rally is VIX found support after it filled the gap. VIX is finding support right here after it filled that gap, right at the top of this gap, top of that the top of that wick where prices gapped up becomes a level of support, and we are hitting that level of support right now as we speak. So if for some reason the VIX does not break that level of support, come back down and break below the 20-day moving average, which I think is highly unlikely. I think it's highly unlikely that we do that. I think we're going to get a bounce here. We're going to need a bounce here. So for all those buy and holds investors, be careful because we are not in a bull market. We are in a bear market. You try to buy and hold this market, it may take you 10 years, 7 to 10 years in order for you to see a profit at this point because we are still in the beginning stages of this market, of this bear market. So just be very mindful and be very careful. These rallies will be sold off. All right, so that's a look at the VIX. Wanted to show that real quick that the VIX really wants to find some support here and go higher. Now, let's take a look real quick at the weekly chart of the VIX. Show you guys something. So as you can see, this weekly chart, it is in a zigzag motion going higher. Right? Notice that. See that zigzag motion? A lot of people look at it as ABDC pattern. I just call it a zigzag motion. Let you know that overall trend of the VIX it's just been trending higher, and that's been going on since November of last year. We go up, down, but creating these higher lows along the way. Look at that, higher low here, higher low here, higher low here. Just going up, up and away. So the weekly chart shows you that this overall trend higher has been snaking higher, taking its time, but the VIX looks like it wants to break out, folks. That cannot be ignored. And looking at the monthly chart of VIX, I keep pointing this out as well. Look how strong the cluster of these candles look on a monthly chart. After we came down from the COVID plunge or the COVID pop, then we got a plunge. VIX came down, found some support, and then it's just starting to curl back higher. Starting to curl back higher. Like a nice little channel, overall rounding channel that's forming. That's how the VIX looks on a monthly chart. So we're coming out of this valley that the VIX was in. It's coming out of this valley, folks, and it's just steady trending higher. It cannot be ignored on the monthly chart. It's taking its time. It's having a rally, a pullback, but it's creating these higher lows. Even in the technicals, you can see creating these higher lows as we continue to rally. So that's a look at a monthly chart of our VIX. Now let's go back to a daily chart real quick. Go back to our regular indexes. All right, so here is the S&P. Same type of scenario. This is a 20-period moving average line that I got here. And again, it's like price action is staying muted right below the 20 per moving average. Got above it here a little bit, but I think we're going to stay muted below it, and we're going to continue to follow this trend down. So the same thing happened last time when price action on this daily chart hovered around that 20 per moving average before in the past. Let me show you what I mean. We got above it here. We stayed close around it. Then once we broke below it, it just followed price action all the way down. And then it got above it again here. And then normally once we get below it, we stay below it for a week or so, week or two. That's what I think is going to happen. I think this 20 per moving average is going to act as a strong level of resistance, but I don't think we're going that high up. Let's take a look at where we could be heading for the SPY. Matter of fact, I meant to put up the S&P actual index itself. So here we go. Here's the S&P actual index itself. Again, I have fib tools on here, and as you can see, former support becomes resistance. Look at that. Price action was coming down, hit support there, bounce, hit support here, bounce, kind of touched it here, bounce, boom, and we gap down below it. Now look what's happening. Former support becomes resistance, resistance, close to it here. And what I believe is that we more than likely to see here. I don't think we're going to make it all the way back up to this level of support of our resistance again. But we have a gap fill. We got a gap right there, and that gap also has been filled. That gap has been filled. So I would not be surprised to start to see price action start to turn downward tomorrow. Could get a little rally in the morning, possible, but I think ultimately we may start to see these rallies start to fade tomorrow. So pay close attention to that. That's the S&P 500. Did we look at the Dow yet? All right. Okay, here's the Dow. So the Dow has not broke below that 23.6% Fibonacci retracement level yet, so it's using it as a level of support. But look at that. Look at that 20 per moving average. It's going to act as resistance. So price action right now, this price action is not going to be able to, I don't think it's going to be able to overtake this 20 per moving average. So we should be seeing some a level of resistance right now, right here, right now, with the Dow Jones. And if we look at where we had a strong bounce before in the past, which is right about here, that lines right up with where price action is now. So former support. Former support, we got a little bounce there. That's a pivot point. So I call that a little support area. Former support becomes resistance. Look at that challenge in here. Challenge in here. We could be in store for a reversal right here, right now. That is the Dow. Now let's take a look at our NASDAQ. Same scenario on the NASDAQ. Nice gap here. So we see that gap there, and the NASDAQ got two gaps. I don't think we're going all the way up here. I think we're going to end up stopping somewhere around here because we're very close to this 20 per moving average. So possibility we can stop here. That's a gap. That gap has almost been filled. So again, we could go a little bit higher. Who knows what tomorrow may bring, but I think we're very, very close to the end of this short bounce. Move that. All right, so that's a look at our NASDAQ, Dow Jones, S&P, and the Russell. Again, folks, be careful as we travel through this market because, again, if I draw your attention to this monthly chart, they are all looking like they all show this sharp sell-off. Here's a monthly chart of our NASDAQ, and you see it right there for yourself. We're in a sharp sell-off to the downside. The monthly chart is this straight channel down, and that is almost every index we look at. You see that straight channel down on the monthly charts. We're definitely in a downtrend. S&P, it's monthly chart. Look at that channel. There we go. Straight channel down on the monthly chart. So all these rallies are just being sold. Straight channel down there. And it just goes on, folks. We are in bear market. It doesn't like this bear market is ready to reverse to the upside at all anytime soon. So where could we actually possibly be going in the I ain't even say in the end, but again, I really think we're going to end up testing the COVID lows. We're going to end up coming back down and test these COVID lows, folks. That's what I think. I think eventually we're going to head to test those COVID lows. So protect yourself, protect your portfolio. If you know how to play the position to the downside, pick something, play the downside movement of this market, because you can fare well. And just be very, very careful. Now, for those who like some downside positions, draw your attention to this HYG. This is one that I've been playing all year long, and I've been showing folks, and I'm gonna show you guys how you can play this market to the downside just by paying attention to patterns and history. HYG, I started noticing I noticed this pullback first of all when we had the COVID plunge right there. So I said this will probably mimic, probably end up seeing that happen again. And so what did I do? In the beginning, when I first started paying attention to this, when we got up right around here, I've been playing puts on this one ever since. And as you can see, we've had a continuous sell-off since then. So eventually, where do I think we're going? Right back to these COVID lows. We're going to drop back below 70. So again, when I started playing this, we were well up here around 90. So just imagine, the profit you were able to take if you were to follow. You was able to follow this trade all the way down, back down below 70. And I think that's where we're heading. I think we're heading to test this 67.52 level, and we should be there soon. And there was more put option activity, heavy put option activity showing here today. And some very heavy, unusual option activity popping up in here today. Again, as I've been showing these, as I've been spotting these, I've been trading this trade, taking this trade all the way down to the downside. With the, let's say it was it July? No, it was September. September contracts. September contracts, they were buying these like hotcakes. Look at this. Around the 68 strike. Somebody, it was over 108,000 contracts traded at the 68 strike. Somebody put a big bet. That is a huge bet that this goes much lower than where it is now. Did I buy all the way down there? No, I do what I normally do. I put on a spread. I bought the 74 strike puts, and I sold the 67s, if I'm not mistaken. Take advantage of the down move. So this is some ideas you can use to take advantage of this downward action in the market as it unfolds. IWM is another one. This one also has been showing some constant heavy put option activity on a regular basis. So this is another one. This is the IWM, which is the ETF that tracks the Russell. And as you can see, there's that downward trending channel that the Russell has been in for quite some time. And with today's rally, it'd be a good time to probably ease on into a position such as this. All right, folks, that's all I have to share with you guys. Hopefully this is something. Oh, but one more thing. I'm sorry. I like to always share this as we approaching the end of the closing day. I like to take a look at the overall highs versus the lows in this market. And then I'm gonna take my dog out because she is really, really under me now, ready to go get some relief. So highs versus lows also tells you it's pretty much just maps out the overall breadth of the market unless you see, where the action is. So This is the New York, this shows you the highs versus lows for the New York Stock Exchange and for the NASDAQ. First tab is going to be for the New York Stock Exchange right now. Right now shows that we have seen 11 new highs for the day, and then we scroll halfway down to show us the new lows. Look at that, 144 new lows. Even with today's rally, the bears are still creating more new lows than the bulls are creating new highs. New York Stock Exchange, 48 new highs. I'm sorry, the NASDAQ, 48 new highs. You scroll down, it'll show us how many new lows. 188 new lows. So again, the breadth of the market is still in favor of the bears. Okay, that's all I have to show you guys. All right, folks, enjoy the rest of your day. Enjoy the rest of your trading week. Trade carefully after this rally because anything is possible from this point on. Oh, you know what? One more thing. I'm sorry, folks. Take a look at the oil market. Let's see if it's trying to find some footing because the oil market also was having a problem finding some footing. So that's an area just to be careful, mindful of. I don't think this rally is over, but it's also been running into some resistance here. As you can see, price action right here on this 4-hour chart is running into some resistance, starting to pull back. So just be careful trading this oil market. I do think eventually it'll find some footing. I'm just not sure when, but I think oil will go higher eventually. All right, folks. Till the next video, this is Tim Davis signing off. Enjoy the rest of your day, and I will catch you guys sometime during the week.